Your note makes mention of the Bulls and Bears, and you use a sports analogy here, and our producer from Chicago, Frost Supermania, would appreciate this. Much like the Chicago Bears, market bears were headed into this year very excited, but apparently they stink. Instead, it's the Bulls, the Chicago Bulls, led by DeMar DeRozan, that have had themselves a year. Give us a little bit more of a breakdown on exactly what that means within the context of the market action this year.
Yeah. So, look, I think there's a lot of discussion that the market is up on kind of Fed-induced, mania. And the real reality is that earnings revisions for this year, so if I wind the clock back to the beginning of the year versus where they are now, the estimate, the market is up only by the magnitude that Wall Street has been forced to revise upwards their outlook for earnings for companies in the S&P. In other words, fundamentals have been far stronger than what Wall Street expected. So that's what's driven the stock market. It's not PE expansion. It's not speculation. It's just good corporate fundamentals. And that's why the market's up this year. So it shouldn't come as a big surprise to anyone that the market's done as well as it has. Last week, I saw revisions go up yet again for this year, next year, 2023. Wall Street's behind where corporate earnings are coming in.
Andrew, I'm going to keep ragging on the Matrix 4 movie because that's 2 hours and 20 minutes I'm never going to get back from my life. But you point out that human behavior does not change. For instance, some of us will continually watch a movie we know is going to be bad, and Doogie Howser, from the beginning, is the bad guy in this thing. But when you talk about these markets, that human behavior does not change, how does that play into an investor's understanding of what we witnessed this year and set up for 2022?
Yeah, so it's the issue is that central bank policy, the old saying, "Don't fight the Fed," becomes ultra accommodative when there's a problem. And when there is a problem, that's what investors focus on. So the level of bearishness last year was very high because we had a real problem with COVID, and that's when the Fed turned ultra accommodative. But this year should not have been a surprise because of this earnings story plus accommodative Fed. But now, as COVID begins to recede, I think investors become more comfortable. So behaviorally, things feel better. But perversely, that's just when the Fed stops taking their foot, begins to take their foot off the accelerator. And that means returns begin to get a little less attractive. So I think next year it's a battle between human behavior that's more optimistic, but the Fed that's going to throw a little cold water on returns.
Andrew, how about the virus itself? Because even with the Omicron variant, even though we kind of know that the U.S. economy is just going to charge through it like it did with the Delta variant, we are starting to see some business closures, and that might be more regionalized to small businesses. But could that be a wrench that throws perhaps that market recovery into 2022 a little bit off kilter?
I don't think so. My view, I've been saying this all year, is that expected risks, the market does not respond to expected risks as badly as unexpected risk. And let me give you exactly what I mean by that as pertains to COVID. When the first outbreak hit and we didn't know anything about it, the market dropped 20, 30%. Okay? That was in March of 2020. We had a re-outbreak in the late summer, fall of 2020, and the market dropped 10%. So 20% the first time, 10% the second time. Now you fast forward to this past summer 2021, and we had the Delta outbreak, and the market dropped 5%. So minus 20, minus 10, minus 5. And I don't think this is going to cause a 5% correction, because what ultimately it's a great lesson is investors say, oh, wait, I knew what happened. The market came roaring back. I'm not going to make the mistake again and sell. So it's really the unexpected risk that affect the market much more severely than what is expected. Now, could that's overall for the market? Could there be areas that have been hurt? Sure. And we bought a lot of the travel leisure stocks early because they've been so beaten down. I don't think that is necessarily an area that I really want to focus on now, because there is, there is going to be these re-outbreaks, and they could have an impact on that. But I don't think the market overall is going to really suffer that much from this outbreak.
Andrew, you also have advice. I'm going to say there are two kinds of investors who watch us. We've got the passive investors who might be passive through their 401ks and index funds. And then you got the stock pickers. You have a warning for the passive investors that next year is the year they need to be on guard. And what advice do you have for them if they want to start using some of their capital, if they can, to pick stocks? What sector should they look at?
That's a great question. So the difficulty for the non-emotional opportunity to investor this year, we haven't had any pullbacks. The maximum pullback was 5%. So if you want to buy into weakness, you didn't get a chance this year. And that's consistent with history, which is, if last year was the first year, 2020, the first year off the low, the second year off the low, the market inevitably does very, very well. It shouldn't have come as a surprise. The third year, which is what we're going into next year, the returns are not as good. They're not negative. So it's way too early to get bearish, but you just can't, the expectations have to be lower. And in a lower return environment, say 5 to 12% returns for the market, you're inevitably going to get more volatility. And more volatility, on the one hand, the emotional investor can get scared out of stocks in a more volatile and lower return year by the bears. The smart investors will give them an opportunity to invest into weakness. So, I say this all the time and with a chuckle, but everyone wants a pullback to invest in. But then there's no such thing as the no reason pullback. There's always a reason the market pulls back, and it always feels, boy, oh boy, this time is different. I'm scared. So my point of that is, look, I think we're going to get bigger pullbacks next year. And if you have cash on the sidelines to invest in, I think it will be a great opportunity. But just be wary when it comes. There'll be plenty of people that will try to scare you into thinking this is the beginning of the end. And the third year off the low, it's way too early to get too pessimistic.
Classic situation there. Who has the thicker skin? But Andrew Slimmon, Morgan Stanley Investment Management Managing Director and Senior Portfolio Manager. By the way, I think it's going to be a Nets Bulls Eastern Conference Finals, but we'll see. Thanks again for stopping by.